Question 1. A registered principal responsible for supervising the activities of registered representatives must establish and maintain written supervisory procedures, WSPs, that address all of the following, except A. Procedures for reviewing and approving new customer accounts. B. Guidelines for the supervision of sales practices and communications with the public. C. Requirements for the annual review of the firm's compliance program. D. Specific instructions for the daily calculation of net capital. Answer: D. Specific instructions for the daily calculation of net capital. Registered principals are indeed responsible for establishing and maintaining comprehensive written supervisory procedures, WSPs, to ensure compliance with securities regulations and the proper supervision of registered representatives. WSPs must cover areas like new account approvals, sales practices, communications, and the annual review of the firm's compliance program, as these directly relate to client interactions and regulatory adherence. However, detailed instructions for the daily calculation of net capital are typically handled by finance and operations personnel, often under the supervision of a financial and operations principal, FINRA, which is a separate principal registration and not a general supervisory responsibility of all registered principals. Therefore, WSPs for general supervision would not typically delve into this level of operational detail. Question 2. Under FINRA rules, a registered representative's participation in a private securities transaction for compensation requires prior written notice to the employing member firm, along with A. A copy of the client's financial statements. B. The firm's written approval of the transaction. C. Disclosure of the representative's ownership interest in the security. D. A commitment to remit all compensation to the firm. Answer: B. The firm's written approval of the transaction. A registered representative engaging in a private securities transaction, often referred to as selling away, must first provide prior written notice to their employing member firm. If the representative is to receive compensation for this transaction, the firm must provide written approval before the transaction can proceed. This stringent requirement allows the firm to supervise the activity as if it were its own business, ensuring compliance, suitability, and proper oversight, which is crucial for protecting investors and maintaining market integrity. Failing to obtain written approval for compensated private securities transactions is a serious violation. Question 3. Which of the following statements regarding the review of retail communications by a registered principal is most accurate? A. All retail communications must be filed with FINRA at least 10 business days prior to first use. B. Retail communications must be approved by a registered principal prior to first use. C. Spot checks of retail communications are sufficient for firms with a strong compliance history. D. Only retail communications that make specific investment recommendations require principal approval. Answer: B. Retail communications must be approved by a registered principal prior to first use. Under FINRA rules, all retail communications, which are distributed to more than 25 retail investors within a 30 calendar day period, must be approved by a registered principal of the firm before their initial use. This requirement ensures that all public-facing materials are fair, balanced, and not misleading, protecting investors from inappropriate claims or information. While some retail communications, like those for new member firms or specific investment products, might require filing with FINRA, the universal principal pre-approval is the most accurate and fundamental requirement. This rigorous review process is a cornerstone of investor protection. Question 4. A broker-dealer's anti-money laundering (AML) compliance program must be approved in writing by A. The firm's designated anti-money laundering officer, AMLO. B. A registered principal of the firm. C. A member of the firm's senior management. D. FINRA's Department of Enforcement. Answer: C. A member of the firm's senior management. Broker-dealers are legally required to establish and maintain an anti-money laundering (AML) compliance program to detect and prevent illicit financial activities, as mandated by the Bank Secrecy Act and FINRA rules. This program must be in writing and, critically, must be approved in writing by a member of the firm's senior management. While a registered principal might be involved in its implementation and an AML officer, AMLO, is responsible for its day-to-day operations, the ultimate approval rests with senior management to signify the firm's highest-level commitment to AML compliance. This emphasizes the critical importance of a robust AML framework in the financial industry. Question 5. In reviewing a new customer account form, a registered principal would be least concerned with which of the following details? A. Whether the customer's investment objectives are clearly stated. B. The customer's signature on the new account form. C. The source of the customer's initial deposit. D. The customer's preferred communication method for account statements. Answer: D. The customer's preferred communication method for account statements. When reviewing a new customer account form, a registered principal's primary concern is to ensure compliance with regulations, the suitability of investments, and the prevention of fraud. Therefore, clearly stated investment objectives, the customer's signature, confirming agreement and authorization, and the source of funds, important for AML and suitability, are crucial details. While a customer's preferred communication method is an operational detail that must be recorded for convenience and delivery, it holds significantly less regulatory importance for the principal's initial account approval than the other factors that directly impact suitability, anti-money laundering, or legal enforceability. Question 6. A registered principal responsible for supervising options trading must ensure that all options communications to the public are: A. Filed with FINRA prior to first use. B. Approved by a registered options principal, ROP. C. Distributed only to sophisticated institutional investors. D. Accompanied by a risk disclosure document for each separate communication. Answer: B. Approved by a registered options principal, ROP. Due to the inherent complexities and risks associated with options trading, FINRA rules impose heightened supervisory requirements on communications related to options. Specifically, all options communications to the public, including retail communications, must be approved by a registered options principal, ROP, prior to their first use. This specialized principal designation ensures that individuals with specific expertise in options thoroughly review materials for accuracy, balance, and appropriate risk disclosure. While other principals may supervise general securities activities, the ROP designation is mandatory for options-related supervision. Question 7. A registered principal discovers that a registered representative under their supervision has engaged in excessive trading activity in a customer's account, generating significant commissions but little benefit to the customer. This activity is best described as: A. Selling away. B. Free riding. C. Churning. D. Matched orders. Answer: C. Churning. Churning refers to the unethical and illegal practice of a registered representative engaging in excessive trading in a customer's account primarily to generate commissions for themselves, without regard for the customer's investment objectives or financial benefit. This conduct violates FINRA's rules regarding just and equitable principles of trade and is a serious breach of a representative's fiduciary duty. Principals must supervise accounts to detect and prevent such practices, which prioritize a representative's compensation over the client's best interest. Question 8. Under FINRA rules, a broker-dealer's annual compliance meeting for registered representatives must cover all of the following topics, except: A. Regulatory requirements and firm policies regarding communications with the public. B. Anti-money laundering compliance. C. Insider trading prohibitions. D. Detailed personal financial planning strategies for representatives. Answer: D. Detailed personal financial planning strategies for representatives. FINRA rules mandate that member firms conduct annual compliance meetings for all registered representatives to reinforce adherence to securities laws, regulations, and firm policies. These meetings must cover crucial topics such as communications with the public, anti-money laundering compliance, and insider trading prohibitions, all of which directly relate to a representative's professional conduct and regulatory responsibilities. However, detailed personal financial planning strategies for the representatives themselves are not a required component of these mandatory compliance meetings, as they do not directly pertain to a representative's duties or regulatory obligations when dealing with the public. Question 9. Which of the following is a key responsibility of a Series 26 principle regarding the approval of customer correspondence? A. All customer correspondence must be filed with FINRA for review. B. Correspondence must be reviewed and approved prior to its first use, with limited exceptions. C. Correspondence is generally subject to post-use review and supervision, not pre-approval. D. Only correspondence related to options or new issues requires principal review. Answer: C. Correspondence is generally subject to post-use review and supervision, not pre-approval. Under FINRA rules, customer correspondence, which is defined as written or electronic communication sent to one or more existing customers or to fewer than 25 retail investors within a 30 calendar day period, generally does not require principal pre-approval. Instead, firms are required to supervise and review correspondence post-use to ensure compliance with firm policies and regulatory standards. This differs from retail communications, which require pre-approval. Firms must establish a supervisory system, including sampling and review, to ensure correspondence is appropriate. Question 10. A registered principal at a broker-dealer is conducting a branch office inspection. Which of the following is an essential element of this inspection? A. Performing a detailed audit of the branch's financial statements. B. Interviewing a sample of customers served by the branch. C. Reviewing customer account records and supervisory procedures. D. Ensuring all registered representatives in the branch are also licensed as investment advisors. Answer: C. Reviewing customer account records and supervisory procedures. Branch office inspections are a critical component of a registered principal's supervisory responsibilities, ensuring that the firm's operations comply with internal policies and regulatory requirements. An essential element of these inspections is the thorough review of customer account records to ensure suitability and proper handling, as well as an examination of the branch's adherence to established written supervisory procedures, WSPs. While interviewing customers or auditing financial statements might occur in specific contexts, the core purpose of a branch inspection is to confirm operational and supervisory compliance at the local level. Question 11. Which of the following statements regarding the maintenance of customer complaints is accurate for a broker-dealer? A. All customer complaints must be submitted to FINRA within 10 business days of receipt. B. Firms must maintain a separate file for each customer complaint, noting its resolution. C. Only written customer complaints require record-keeping, verbal complaints do not. D. Customer complaints must be retained for a minimum of 3 years. Answer: B. Firms must maintain a separate file for each customer complaint, noting its resolution. Broker-dealers are required under FINRA rules to maintain comprehensive records of all customer complaints, whether written or verbal. For each complaint, a separate file must be created that includes the complaint itself, or a memorandum if verbal, the firm's response, and any action taken to resolve the issue. This detailed record-keeping is essential for demonstrating compliance with regulatory obligations and for allowing FINRA to monitor firms' handling of customer grievances. These records generally must be retained for a period of 6 years. Question 12. A broker-dealer must verify the identity of a new customer. Which of the following actions is required under the USA Patriot Act? A. Obtaining a copy of the customer's birth certificate. B. Confirming the customer's name does not appear on any FINRA disciplinary lists. C. Checking the customer's name against the Office of Foreign Assets Control, OFAC, Specially Designated Nationals, SDN, list. D. Receiving a sworn affidavit from the customer regarding their source of funds. Answer: C. checking the customer's name against the Office of Foreign Assets Control, OFAC, Specially Designated Nationals, SDN, list. The USA Patriot Act mandates that financial institutions, including broker-dealers, implement customer identification programs, CIP, to verify the identity of new customers. A critical component of the CIP is checking the customer's name against government lists of known or suspected terrorists and other prohibited persons, most notably the Office of Foreign Assets Control, OFAC, Specially Designated Nationals, SDN, list. This measure is designed to prevent individuals involved in terrorism or other illicit activities from using the financial system. Question 13. A registered principal must ensure that all new customer accounts are approved promptly after their initial transaction. What is the maximum time frame permitted for a principal to approve a new account after the first transaction? A. Immediately, on the same business day. B. Within 1 business day. C. Within 3 business days. D. Within 7 business days. Answer: C. Within 3 business days. FINRA rules require that a registered principal promptly approve all new customer accounts. Specifically, this approval must occur within 3 business days of the initial transaction in the account. While firms may have internal policies requiring immediate or same-day approval, the regulatory maximum timeframe for principal approval after the first trade is 3 business days. This ensures that a qualified supervisor reviews the account information and suitability determination in a timely manner after activity commences. Question 14. Which of the following is not typically required for a registered principal to review and approve regarding investment company products? A. Sales material and advertising for mutual funds. B. The suitability of variable annuity recommendations. C. The daily net asset value, NAV, calculation for an open-end mutual fund. D. Supervisory procedures for the sale of unit investment trusts, UITs. Answer: C. The daily net asset value, NAV, calculation for an open-end mutual fund. Registered principals are crucial in overseeing the sales and marketing of investment company products, ensuring that all communications are fair and balanced, and that recommendations are suitable for clients. This includes reviewing sales materials, approving variable annuity recommendations based on suitability, and establishing supervisory procedures for products like unit investment trusts, UITs. However, the daily calculation of a mutual fund's net asset value, NAV, is a mechanical, operational function typically performed by the fund's administrator or custodian, not a supervisory responsibility of a sales principal. Question 15. A member firm must have written procedures for the review of incoming and outgoing correspondence and communications. The frequency and extent of this review must be: A. Daily for all communications. B. Monthly, with an emphasis on new representatives. C. Reasonable and consistent with the firm's business, size, and structure. D. Annually, focused solely on complaints. Answer: C. Reasonable and consistent with the firm's business, size, and structure. FINRA rules require member firms to establish and maintain written procedures for the review of correspondence and other communications. The frequency and extent of this review are not rigidly defined as daily or monthly for all firms but must be reasonable and consistent with the firm's business, size, structure, and the nature of the communications. This allows for flexibility while ensuring effective oversight, meaning a smaller firm might have different procedures than a large, complex one, but both must ensure proper supervision. Question 16. A registered principal must supervise a registered representative's outside business activities, OBAs. If the OBA involves a private securities transaction for compensation, the firm must: A. Simply acknowledge receipt of the written notice. B. Grant written permission for the OBA. C. Supervise the OBA as if it were a firm transaction. D. Prohibit the representative from engaging in the OBA. Answer: C. Supervise the OBA as if it were a firm transaction. When a registered representative engages in an outside business activity (OBA) that also qualifies as a private securities transaction for compensation, i.e., selling away, the employing member firm's obligations go beyond mere acknowledgement. In such cases, the firm must specifically approve the transaction in writing and then supervise it, as if the transaction were executed on behalf of the member. This heightened supervisory requirement is crucial because the firm bears regulatory responsibility for the representative's compensated securities-related activities, even if conducted outside the firm's usual scope. Question 17. Under FINRA Rule 3110, Supervision, a member firm must conduct an annual review of its supervisory system. This review is primarily to a. Determine the annual compensation for supervisory personnel. B. Assess the firm's financial health and capital adequacy. C. Ensure the system's effectiveness and compliance with regulations. D. Identify opportunities for new product development. Answer: C. Ensure the system's effectiveness and compliance with regulations. FINRA Rule 3110 requires member firms to conduct an annual review of their overall supervisory system. The primary purpose of this review is to determine its effectiveness in ensuring compliance with applicable securities laws, regulations, and the firm's own written supervisory procedures. This annual assessment helps firms identify any gaps, weaknesses, or areas needing improvement in their supervisory framework to mitigate risks and maintain regulatory adherence. It's a proactive measure to ensure ongoing compliance rather than a financial or business development review. Question 18. A registered principal observes that a registered representative is excessively recommending mutual fund Class B shares to customers, despite the fact that Class A shares would be more suitable given the customer's larger investments and longer time horizons. This behavior is a potential violation of which sales practice rule? A. Free riding. B. Market manipulation. C. Suitability. D. Insider trading. Answer: C. Suitability. The scenario described directly relates to the suitability rule, which requires registered representatives and their firms to have a reasonable basis for believing that a recommended transaction or investment strategy is suitable for the customer, based on the customer's investment profile. Recommending Class B shares, which typically have higher surrender charges and 12b(1) fees over time, when Class A shares would be more advantageous due to lower long-term costs for larger investments, constitutes a potential suitability violation. Principals must ensure representatives prioritize client interests over higher commissions. Question 19. If a registered representative voluntarily terminates their registration with a member firm, the firm must file Form U-5 with FINRA within a. 10 business days of the termination. B. 30 calendar days of the termination. C. 60 calendar days of the termination. D. 90 calendar days of the termination. Answer: B. 30 calendar days of the termination. When a registered representatives association with a member firm terminates, the firm is required to file a Form U-5, Uniform Termination Notice for Securities Industry Registration, with FINRA. This filing must be made within 30 calendar days of the date of termination. The U-5 includes information about the reason for termination, and any disciplinary disclosures, which is crucial for regulatory oversight of individuals in the securities industry. Firms must adhere strictly to this timeframe. Question 20. Which of the following records must generally be retained by a broker-dealer for a minimum of 6 years? A. Customer new account forms. B. Retail communications. C. Customer complaints. D. All of the above. Answer: D. All of the above. FINRA Rule 4511 specifies record retention requirements for broker-dealers. Customer new account forms, retail communications, and customer complaints are all examples of records that generally fall under the 6-year retention rule from the date of the record or the close of the account. This extensive record-keeping period is vital for regulatory examinations, dispute resolution, and ensuring accountability within the securities industry. Firms must maintain these records in an easily accessible manner for the required duration. Question 21. A broker-dealer creates an institutional communication intended for use with qualified institutional buyers. Which of the following is true regarding principal approval for this communication? A. It requires pre-approval by a registered principal. B. It requires pre-approval by a registered options principal, ROP. C. It does not require pre-approval by a registered principal, but rather post-use review. D. It must be filed with FINRA prior to its first use. Answer: C. It does not require pre-approval by a registered principal, but rather post-use review. FINRA defines institutional communication as any written communication distributed only to institutional investors. Unlike retail communications, which require pre-approval by a registered principal, institutional communications do not require principal pre-approval. Instead, firms are required to establish a system for the supervision and review of institutional communications, which typically involves post-use review. This relaxed pre-approval standard reflects the assumed sophistication of institutional investors. Question 22. A registered principal identifies a potential red flag indicating possible money laundering activity in a customer's account. What is the immediate required action? A. Close the customer's account immediately. B. Notify the customer that their activity is suspicious. C. File a suspicious activity report, SAR, with FinCEN. D. Begin an internal investigation to gather more evidence before taking action. Answer: C. File a suspicious activity report, SAR, with FinCEN. If a registered principal or any firm employee identifies a potential red flag indicating suspicious activity that might be related to money laundering, the immediate required action is to file a suspicious activity report, SAR, with the Financial Crimes Enforcement Network, FinCEN. This is a critical component of the firm's anti-money laundering, AML, compliance program. It is prohibited to inform the customer that SAR has been filed, a practice known as tipping off. Firms must act promptly on suspicious activity. Question 23. Under FINRA rules, all registered representatives must complete firm element continuing education. A. Annually, by December 31st. B. Every 3 years, regardless of their registration date. C. As determined by the firm based on its needs and the representative's duties. D. Only when they obtain a new registration or license. Answer: C. As determined by the firm based on its needs and the representative's duties. The firm element is one component of the securities industry's continuing education, CE, requirements, distinct from the regulatory element. For the firm element, FINRA Rule 1240 requires member firms to identify training needs for their registered personnel at least annually and to provide appropriate training. The specific content, frequency, and format of this training are determined by the firm based on factors such as changes in regulations, new products, and the representative's job functions, ensuring the training is relevant to their responsibilities. Question 24. A registered principal learns that a registered representative has been accepting undisclosed referral fees from an unregistered third party for directing clients to a specific investment. This is most likely a violation of the firm's policies concerning A. Gift limits. B. Business continuity planning. C. Outside business activities or conflicts of interest. D. Suitability for institutional clients. Answer: C. Outside business activities or conflicts of interest. Accepting undisclosed referral fees from an unregistered third party for directing clients to a specific investment constitutes an unapproved outside business activity and a serious conflict of interest. Such activities can lead to representatives prioritizing personal gain over clients' best interests and may involve engaging in private securities transactions without proper firm oversight. Firms must have robust policies and supervisory procedures to prevent and detect these types of undisclosed arrangements, ensuring transparency and preventing potential harm to clients. Question 25. Which of the following is primarily responsible for ensuring that a broker-dealer's business continuity plan, BCP, adequately addresses potential disruptions and is updated annually? A. The firm's chief financial officer, CFO. B. A registered principal of the firm. C. The firm's designated business continuity coordinator. D. A member of the firm's senior management. Answer: D. A member of the firm's senior management. FINRA rules require member firms to create and maintain a written business continuity plan, BCP, to address how they will respond to significant business disruptions. While a specific coordinator or registered principal might manage the plan's details, the rule explicitly states that the firm's senior management must approve the BCP and review it at least annually. This ensures that the highest level of leadership commits to and oversees the firm's preparedness for emergencies, which is critical for protecting customers and maintaining market integrity.